If income taxes are confusing to you, well, you're probably not alone. This week on Money in Your Pocket, David McGrady will be here to run us through common tax terms and questions. We'll look at the 1040 tax form in more detail and explain what some of those terms and deductions can mean for you. That's all coming up next on Money in Your Pocket.
This program is made possible in part by Credit Union One, proud to support Money in Your Pocket. Credit Union One offers savings and lending options. Additional information on membership available at creditunionone.org. Loans subject to approval. Accounts are insured up to $250,000. By members' choice, this institution is not federally insured.
Hello and welcome to this edition of Money in Your Pocket. Today we are going to try and demystify taxes with our friend David McGrady from EIU School of Business. Dave, thanks for coming by.
Enjoy it, thank you.
So we both have a copy of the 2014 1040 form right here, and we're going to kind of go through this and get ourselves educated about taxes.
Okay.
This is, why are they so confusing? First of all.
Well, there's a lot of things obviously that go into the income tax code, but basically it's designed around, in some degree, fairness. If I'm an individual that has a $100,000 salary, but yet for whatever reason I had to spend $60,000 on medical expenses out of pocket last year, and you're making $100,000 and not in that same situation, should we pay the same amount of income taxes? And you can make an argument that perhaps maybe we shouldn't. And then obviously there's a lot of social policy in there, some things to encourage us to do certain behaviors like fund our child's education or perhaps buy a house, those types of things.
Mm-hmm. So everybody has different situations, so there really isn't one, it's not really one size fits all, which makes it complicated.
Right, and we're going to try to do as best we can today
All right.
to make this simple, but certainly consult your tax advisor because there's going to be exceptions to what we talk about today.
Yes, of course. What do you think is the most, I think in the old days probably a common mistake was mathematical, but if you use tax preparing software, it does it for you.
Right.
So what, in this day and age, do you think is a common mistake that people make?
I think a lot of it deals with the misconception of what's actually reduces your tax liability and what doesn't. In the past, when interest rates were much higher, a lot of people took advantage of the itemized deduction. And so therefore, things like your mortgage interest, your property taxes, your state income taxes, all reduced your tax liability. But as interest rates have come down so much, I see fewer and fewer people that itemize now. And so even though technically they are deductible, they turn out to not reduce our tax liability. So that's certainly something that I think most people have a little bit different feeling versus what actually goes on.
So you can't deduct just everything and make it up and try and justify it. The IRS will find you in some way, shape, or form.
Yeah, let's say that that's not the case.
Okay.
There are statistics that are available on what for different levels of income you would expect to see, for example, charitable contributions be, mortgage interest to be. So if things look unusual, that may sometimes get you in trouble.
Right. All right, so let's kind of look at this 1040 form, and we're going to go through some things that just to get ourselves, we might not be doing our own taxes, but it's always good to understand some of this. So a filing status is pretty obvious. Let's get down.
We'll talk about filing status for just a second because what determines whether or not I file married filing joint. And,
or married filing separate.
Or single. And one of the things we have to be aware of is the fact that there's only one day that matters for your marital status, and that's December 31st.
Okay.
So if you could be single the whole year, get married on December 31st, you're considered to be married for that particular year.
Okay.
Married filing separate typically deals with maybe classically in textbooks, they talk about a liability situation where you don't want the joint liability with your spouse. But I've also seen it with maybe couples who they lost their spouse earlier, and so this is a second marriage for them, and maybe their 70s, 80s. They don't want to combine their finances together, so they just keep everything separate. So you will see that in that particular situation. Another fairly common filing status is head of household, which the important thing to understand with the filing status, it does determine the tax brackets that we go to, and classically for a given amount of income, married filing joint is going to have the lowest tax rates, and then the head of household status will fall in between, and then single for a given level of income will tend to create the highest tax liability.
All right, and I also see number 5 on here is a qualifying widow or widower with a dependent child.
That's a pretty unusual situation, because that's a situation where you lose your spouse during the year, and when you lose your spouse during the year, you can still file married filing joint for that particular year. But if you have a child, dependent child still, then you can also take this filing status for the next 2 years, which essentially is the same as married filing joint. So again, it gives you the lower tax rates for that given level of income.
All right, so we've covered filing status. Let's get down now to exemptions.
Going to have one obviously for yourself, one for your spouse if you have one. It gets a little bit tricky with children. I mean, once they hit college age, do we claim them as a dependent or not? Generally, it's based upon whether or not you provide more than half of their support. So for most people, they're going to maintain claiming their kids as a dependent until they're done with college and quote unquote out on their own.
All right, so what do you do if you as the parent claim your college-age child as a dependent, and they went ahead and filed on their own, and they didn't tell you that?
Then you've got a problem, because that's certainly something that is going to get matched up.
Okay.
It's going to kick out the returns.
All right.
Yeah, that's not a good strategy to do that.
So make sure you're talking to your kids and who's filing what.
Yes,
All right, so then we got this big section called income, and this is
Right.
where the W-2s come in, where we get those from our employers. And so let's head into that section.
Okay. The general rule is, unfortunately, here that everything is taxable. And so there are a few exceptions, like municipal bonds, the interest income from municipal bonds, life insurance proceeds. But in general, everything is taxable. So it's just a matter of where does it fall on the return. So, obviously some of the more straightforward things are wages and interest. It is somewhat interesting that we do report municipal bond interest income on our tax return, even though it's not taxable. But the reason we do that is it can impact whether or not our Social Security benefits are taxable. So it can end up being indirectly creating a larger tax liability for us. The dividends, one of the interesting things about dividends for the people that still have mutual funds is that a lot of people will elect to reinvest their dividends back into the mutual fund. So basically say, don't send me a check, just buy more shares of the mutual fund. And you can also do that with shares of individual companies too.
Right.
And if you do that, even though you didn't receive any cash, that's still taxable, because it's basically viewed, you could have had the money if you wanted the money. So that's kind of one thing that can come up with dividends. One of the other things we run into here is alimony. It is important to understand that alimony is considered to be taxable, but child support is not taxable. And so there's a distinction between those two things. Business income, one of the most important things we have to understand for people that end up starting a business someday is that not only do you have income tax liability from the business, but you also have to pay self-employment tax, which essentially is the equivalent of the Social Security that's withheld from people's wages. That's matched by the employer. Well, as a self-employed individual, essentially you have to pay both halves. So on top of the income tax, we also have to deal with this self-employment tax. With capital gains, obviously that's when you sell something, classically be stocks, ETFs, mutual funds, for more than what you paid for it. And so that creates a capital gains tax liability, which a lot of people view as a voluntary tax, because if I don't want to pay it, I just simply don't sell the asset. I just continue to hold on to it. And so because it is somewhat a voluntary tax, it is subject to a lower tax rate regime than the regular income tax rates are. And so that's important to understand too, that if I have a $20,000 gain from selling a stock, that in general is going to be taxed at a lower rate than if $20,000 of wages.
All right, so would a capital gains come into play if you had a house and you sold it for a big profit? Is that fall under capital gains or not?
Yes, technically that is, as we said, everything's taxable unless we tell you otherwise. It is taxable. Fortunately, there are exceptions to that. And in this case, as long as you meet some fairly simple tests that most people are going to meet, you can exclude up to $500,000 of gain on the sale of your home. So in this area, that's not a problem. Some people in New York City think that's way too low, but nobody around here complains about that.
All right, so there's a lot of other things on here as far as income goes. A lot of it doesn't apply to most people, but there are things like Social Security benefits, real estate, farm income.
Right, and particularly with Social Security benefits, it's important to understand just the general rule is that if you have modest levels of income, that your Social Security benefits are not going to be taxable. But if you do have a fair amount of income during retirement, and for example, if your income's over about $44,000, in that situation, then 85% of your Social Security benefits will be taxable. So there's some pretty intricate tax planning that you can do in terms of how do I take distributions from different types of retirement accounts if you have the access to Roth accounts, for example, where maybe that can reduce your Social Security, the tax of your Social Security benefits.
And your financial planner, advisor, your CPA can kind of
it's pretty complicated, but in general, very modest levels of income, no tax on your Social Security. Higher levels of income, you do have to worry about the tax that you're going to have to pay on your Social Security benefits.
Is there anything else we need to go through income before we get to adjusted gross income? This is where the rubber meets the road.
Yeah, I think the only other thing I would add, Lori, is that a lot of people have heard of Roth IRAs and Roth 401ks. And one of the things that you do have to understand is for those distributions to be tax-free, that the funds have to have been invested basically for 5 years, and you have to be over 59.5 when you take them out. So they will not be taxable versus distributions from a traditional IRA, which would show up here.
Yeah.
Okay.
All right. So adjusted gross income. Explain first of all just what is that?
Adjusted gross income is basically the starting point for a lot of different calculations. So there are a lot of phase outs that are based upon what's called modified adjusted gross income. And so this kind of builds off this adjusted gross income. But we have phase outs. If your income is high enough, you can start losing the benefit of some of your personal exemptions that we talked about early in the show. You can also lose the benefits of some of your itemized deductions. And so it's kind of an in-between point to get from all income to taxable income. The other thing that's important to understand as we look at this page is the fact that everything that's listed here on this page here at the bottom under adjusted gross income, these are all things that are going to reduce our tax liability. Now, there is a difference between a deduction and a credit that we need to understand. For example, we might receive a credit for what we paid for daycare expenses for our kids, or if we have a young kid, we might be entitled to the $1,000 child tax credit. Well, those reduce our tax liability dollar for dollar. What's going on here, for example, if I contribute to a traditional IRA, or if I pay student loan interest, which are deductions that are showing up in this section, that's going to reduce my tax liability by X dollars, let's just say $1,000. And then let's say I'm in the 25% tax bracket. And when we talk about tax brackets, classically what we're talking about is your marginal tax bracket. That is, we change your income by $1, is your tax liability going to go down by 25 cents or 15 cents or 10 cents? That's a lot different than some people think about the fact, well, okay, I make $50,000, I pay, just to make the math easy, let's say $10,000 in income taxes, which would be a little too high. But then, I'm at a 20% average. That's what I pay on average. Well, that's really not relevant to your tax decision. What you need to think about is what's the next dollar that I either save in reducing my tax liability or receive an income, what's that going to do to my tax liability? And that's your marginal tax rate, which is what we're worried about.
All right, so this adjusted gross income, this is basically things that are reducing your income that is subject to tax.
Yes, and it's always should always reduce your tax liability. So
what are some of the things that go into that?
Some of the most common ones we see are individuals that are self-employed. We get to deduct 1/2 of the self-employment taxes as an expense. Very common to see also for self-employed people, they're going to have self-employed health insurance. So for people that are self-employed, that's going to reduce their tax liability. Whereas for individuals that have health insurance through their job and maybe they pay some of the costs out of pocket, then we have to go back and see if we're going to be able to itemize, and then there's another threshold that we have to meet even before we itemize to see if it's going to provide us any benefit.
I see that moving expenses are on here.
Yes, yes.
So if I move cross country, I leave Charleston and I head to New York, I can deduct that moving truck expense?
Well, it depends on why you're going to New York.
Say I get hired by,
Okay.
you know, the big PBS station.
Okay, there you go.
New York, WNET.
Okay, there you go. Yeah, then we're in good shape because presumably you're moving there to start a new job, not just because you wanted to move to a different town. And then also the other thing we have to look at is, did your commute go up? And your commute has to increase by more than 50 miles. So unless you were commuting to WEIU from somewhere in New Jersey, I think you'd be in good shape and you could deduct your moving expenses.
Okay. I think another common one that we're seeing a lot of is health savings account deductions.
Yes, those are becoming more common where employers are shifting. To be able to do this, you have to have a high deductible health insurance plan. And it is important to understand that this deduction is for the amount that you pay out of pocket.
Okay.
That if your employer contributes to the HSA, you don't have to include that as income, but then you're not going to turn around and be able to deduct what your employer contributed to the HSA. So this is for what you contributed to the HSA.
So we actually have alimony is paid. Alimony came up in the income section, but it also comes up in the adjusted gross income section too.
Right. So obviously for the individual receiving the alimony, they report it as income, and then for the individual paying the alimony, they get to deduct it in this particular section.
Okay. There's two things on here, tuition and fees and student loans. So those apply to people in college, correct?
We're in college, hopefully done with college now. One is the student loan interest deduction, and this was a nice change, probably 10 or 15 years ago, where it used to be originally student loan interest wasn't deductible at all, and then it kind of went through where it was part of your itemized deductions, and then now you can deduct up to $2,500 in general. Student loan interest, again, it can be phased out if your income is too high. But the other one, the tuition fees, that's a fairly complex situation where in general you can receive credits rather than deductions, depending on where your child is in college and if they're full-time or part-time. The credits are what we want because those are dollar for dollar reduction, the Lifetime Learning Credit and the American Opportunity Credit. This is for a very unusual situation where you're phased out of that. Your income is too high, so you can't take advantage of those credits, but your income is not too high where you can deduct it on your tax return. It doesn't happen real often. I see it every once in a while.
All right. Okay? So I do have a question about, you brought up itemizing and credits. So if I understand this right, you have to have enough, when you want to itemize, it has to be more than what the standard deduction is to make it worthwhile.
Correct. Yes.
And a lot of people, that doesn't it ends up not applying. I think I tried it a couple times and I never had enough.
Right.
Okay.
Yeah, and for 2015, the standard deduction for somebody married filing joint is $12,600. So with that level, that threshold that you have to pass, I mean, typically you have to be a relatively high income taxpayer and typically have a fairly high mortgage still to accumulate that amount of itemized deductions. So even though people will tell you things like if you give this amount to charity, you can deduct it on your tax return, the reality is it may not do you any benefit. Now, if you're, let's say you're in a situation where maybe your itemized deductions would average around $10,000 a year, and you're thinking, gee, I really want to give a lot of money to WEIU, what you might do is instead of giving them $2,000 each year, is to bunch your itemized deductions and give them $5,000 in 1 year and nothing in the following year. And that would put you over the threshold in 1 year, provide advantage, and then you'd fall back under the other year.
Okay. So if you're not itemizing, does that mean you don't have to keep every darn receipt for everything?
Correct. Yeah. That, for example, all the old clothes you take to Goodwill and stuff like that, that's probably, if you're not itemizing, that's not going to do you any good.
All right. Okay. So we've just been given the 5-minute cue, and we still have page 2 to go through. Anything else on adjusted adjusted gross income before we go on
No,
to tax and
we've
credits?
hit all the
Okay.
main things there.
All right, so now we're on to tax and credits.
Yeah,
What do we
and-
need to know here?
Well, unfortunately, we've already looked at some of this stuff
Okay.
before, where on the second page, what we're doing is subtracting the standard deduction, which we've talked about, and then the amount of exemption that we get for each dependent. That brings us down then to taxable income. And so we subtracted the standard deduction, we subtracted $4,000 in 2015 for a dependent, and in general, then the taxable income is the number that our tax is based on. So
Okay.
then we go to these tax brackets that we've referred to, calculate our tax. There are some strange things on here that hopefully you don't ever fall into. One is alternative minimum tax, which is a second way to calculate your tax, and you get to pay it if your tax turns out to be higher than the regular tax. It does happen to people. It's not such a big deal in Illinois. It tends to happen in people that live in high state income tax states,
Okay.
get to pay alternative minimum tax, but you do see it some here. The better things that we want to talk about
All
are the
right.
credits. And the credits we mentioned earlier, one is for what we pay for dependent care expenses. We can get a credit for that. What we pay for our kids' education, what we pay out of pocket, we can get credits for that. There's also a retirement savings credit that if you have a fairly modest level of income, contribute to your 401k or to your IRA, you can get a credit for that. All these are subject to phase outs, so you again consult with your tax
What
advisor.
does a phase out mean?
Basically, it means, again, that your income can't be too high.
Okay.
So, and we talked about how we build off of that adjusted gross income to determine, is your income too high? So, we hope that we qualify, but again, talk to your tax professional and see where you're going to fall with that. And same thing with this $1,000 per kid child tax credit.
Again, this is starting to be clear as to why taxes are complicated, because there's always a if this, then that, but not this. And
Right, but as long as you understand the general rules of things that might qualify, for example, knowing that if I pay some of my kids' college tuition, I might get a credit, and talk with your tax advisor ahead of time to see what the thresholds are and how I properly do this. We can do, if you talk to them ahead of time, we can structure it properly. If you talk to them after the end of the year, it's pretty hard to erase what's already happened.
We had a CPA on last year, Matt Sikander, and he said, talk to your tax professional throughout the year. Don't
Yes.
just wait until you got your pile of stuff and hand it
The
up.
best money you'll spend on them is talking to them before December
Non-
31st,
yeah.
not after December 31st.
Yeah, so you can
because
kind of start
yeah.
thinking about this, right? than
yes,
trying to
it's
hurry up.
much harder to do it afterwards.
Okay, so we got 2 minutes left, Dave. So
Okay.
we're in the home stretch here. What else
Yes,
do we
ma'am.
need to know? We may have to do another show.
One thing I will point out is you do need to be aware that if you take distributions too early from your retirement plans, that they can be subject to an additional tax
Okay.
in addition to the regular tax, a penalty for taking early withdrawals of the funds. And then we do now have the requirement that we all have health care coverage, and so there are some additional taxes associated with that. So again, you need to be aware of that if you have to worry about that situation. And then now we get to the fun stuff, the bottom line.
The refund.
Do we get a
Hopefully the
refund or
refund
not?
or not.
Yes, yes. And that's kind of a subject to debate about whether or not you want a big refund. I think it deals with a lot of other issues in terms of how you manage money, but certainly you don't want to be vastly underpaid, because there are penalties that can come into play if we didn't have enough withheld during the year. And particularly, it's a tough situation for individuals that start a business or individuals that start to accumulate a little bit of investment property of some type that generates incomes not subject to withholding. So then you can be looking at a situation where you owe not only taxes at the end of the year, but also penalties because you failed to pay in enough as you went along.
Okay. Well, we didn't get through everything, but this is a very important question, and
Okay.
Matt brought it up several times.
Yes.
And I want you to ask, how will the IRS contact you? Do you know?
Well, typically you get a letter.
Yes.
Okay. And and they're good. I mean, you can
Yeah.
respond to the letter, and you respond back with a copy of their letter, and they do the best they can. Obviously,
Right.
a very overwhelming job,
Yeah.
but typically what they're looking for is just an explanation of what happened here, because they are more and more trying to match up documents, like
Right.
why didn't this show up on your tax return? And so a lot of times that's what creates letters where they're confused about, well, we thought this and you're telling us that.
I will reiterate what Matt said last year, is they will contact you by letter, they will not call you, and they will not show up on your doorstep or email you. So be be suspicious of that. I suppose if they show up on your door, that means you maybe avoided them too many times. But
that's another show, yes.
Yes, that's another show. So what we want to end with here is make sure you're consulting your tax professional. This is just advice.
Yes.
So Dave doesn't want to get any phone calls about what you said on this show. It is complicated, and as you said in the beginning, everybody's tax situation is different.
Right, but I mean, as you learn to, particularly later in life, as you learn to deal with the complexities, it's all about planning.
Right.
There's a lot of opportunities out there. If you're aware of them, you can take advantage of them and perhaps reduce your tax liability.
Right. Well, I feel a little bit more educated now going into this tax season. I understand this a little more because it can be very intimidating. And even if you have somebody do your taxes, it's good to be educated about what all this stuff is.
Exactly, because you know when to raise issues, but also too what type of information to provide them. Because sometimes, if you don't tell me that you contributed to a traditional IRA, I don't know.
Yeah.
So.
All right. Well, the buzzer has sounded. Our time is up, Dave.
All right.
Thanks for coming back to Money in Your Pocket.
Okay.
Great
Enjoyed
having
it.
you.
Thank you. Bye-bye.
Here's the bottom line for income taxes. Planning ahead makes filing time a whole lot easier. If you use a tax professional, talk to them throughout the year, especially if life events or circumstances change. Be knowledgeable about your filing status and which one is going to work best for you. Learn about what credits are available and if you qualify. Remember that some credits can offer a dollar for dollar savings. The most common credits are for childcare and education. Even if you don't prepare your own taxes, it's always a good idea to be educated about these common tax terms. And finally, if the IRS does contact you, it will be by mail. Phone calls, texts, and emails should be suspect. That's our show for this week. Check us out online at youtube.com/WEIUTV and come back and see us again for Money in Your Pocket right here.
This program is made possible in part by Credit Union One. Proud to support Money in Your Pocket. Credit Union One offers savings and lending options. Additional information on membership available at creditunion1.org. Loans subject to approval. Accounts are insured up to $250,000. By Members' Choice, this institution is not federally insured.